Welcome back to Investing Talk Podcast. Today we are strapping in for a look at AST SpaceMobile. Now, this is a pre-commercial company, right? It's been absolutely, well, burning up the charts, capturing a lot of attention, huge potential, definitely, but also, massive risks involved.
Yeah, exactly. And we're really trying to tackle that central question for you, the investor. Is AST SpaceMobile a good time to buy now?
Mm-hmm.
Because, I mean, when you look at the raw data, it's really the definition of speculative. High risk, high reward. The company currently reports zero revenue. Zero. Yet somehow it's seen this staggering 221% rally year to date.
That rally is exactly why everyone's talking about it, isn't it? Before we really dig into why that's happening, though, just a quick reminder, please make sure you subscribe, like, and comment on this discussion. And actually, if you have a specific company you want us to look into for a future analysis, just leave a comment below. We really do build these conversations around what you need to know.
Right. So our mission today is, well, to provide some clarity on this. We're going to unpack the fundamentals, the technology, look at the powerful market momentum, the key competitive advantages, the moat, if you like, and crucially, those pivotal near-term catalysts, things that could really make or break its current valuation.
Okay, let's get into it then. Let's unpack this. Why on earth is a company with zero revenue getting a 221% run-up? I mean, it has to come down to the technology, surely. What exactly is this unique moat that AST SpaceMobile supposedly possesses?
It really is all about disruption. Their core tech, using these Bluebird satellites, promises something genuinely unique. It's direct connection to regular mobile phones, like the one in your pocket right now. You, the customer, you don't need special dishes, no special antenna, no new hardware at all. And that capability, that seamless integration with existing mobile infrastructure, well, it seems pretty much unmatched by competitors right now. It creates this huge scalability advantage.
Ah, okay. So that's the critical difference then. They aren't trying to sell us all a new gadget. They're basically selling wholesale network infrastructure that just works with the, billions of devices already out there.
Exactly. And critically, they seem to have secured the foundational customer flow already. It's actually fascinating how robust this pipeline looks, even pre-commercial. They've got commercial partnerships with massive players. Yeah. I think AT&T, they've committed $100 million through 2030, plus Verizon, Vodafone, Rakuten. These kinds of deals essentially guarantee a future customer base. It's going to be really tough for rivals to disrupt that once the network's actually running.
Mm-hmm. And they also secured the plumbing, right, which often gets overlooked, that global S-band spectrum deal.
Yes, the $64.5 million deal for the S-band rights, that's absolutely crucial. For listeners who might not know, S-band is a key piece of the radio spectrum puzzle for this kind of communication.
Yeah.
Locking down those global rights gives them priority access, basically underpins a durable long-term network advantage. And their strategic positioning is smart too, I think. They aren't trying to go head-to-head with AT&T or Vodafone directly. They're positioning themselves as an infrastructure provider to those telcos. That model often leads to more regulatory stability, more predictable revenue streams eventually, which is pretty important when you're building out a global satellite constellation that costs billions.
Okay, yeah. So here's where it gets really interesting. The tension, right? This huge valuation versus, the current financials. Let's talk about the cold, hard numbers for a company that's still, pre-commercial.
Yeah, the financial reality is pretty much what you'd expect for a capital-intensive tech startup deep in R&D. AST SpaceMobile reported zero revenue for the first half of 2025, just flat zero.
Okay. And their net loss for Q2 2025, I saw that was, $44.2 million? How concerning is a loss like that, especially when you think about the sheer amount of capital needed to launch a full satellite system? Does that cash burn rate put their runway in jeopardy?
It's a very relevant question. That loss figure, it is consistent with what management guided. It's basically money poured straight into R&D, into getting those satellites built and deployed. The outlook, however, the future projections, that's what's justifying the stock price, at least in the bullseyes. Analyst projections are pointing towards really rapid, almost transformative earnings growth once they hit commercialization. Expected late 2025, maybe early 2026. They're basically betting on monetizing that multi-billion-dollar partnership potential we just talked about.
Right. So investors are buying the promise of this infrastructure becoming operational maybe next year sometime. But for a company burning cash like this, how strong is the balance sheet right now? Can they actually make it to that point?
Well, for this stage of development, the balance sheet looks surprisingly stable, actually. As of June 30th, 2025, they had about $169.3 million in cash and cash equivalents. According to their filings, that should provide enough runway to sustain development and satellite ops for at least the next fiscal year. So no immediate critical cash crunch appears imminent.
Okay, that gives them a bit of a buffer then, against, say, execution delays or something.
It does, and total liabilities are around $114.1 million. But here's the really remarkable figure, I think, especially for a company building satellites. They have no long-term debt outstanding, none. That lack of significant leverage is, well, highly favorable compared to many capital-intensive peers.
Yeah.
Now, obviously, their free cash flow is negative. They're spending more cash than they generate. That's totally expected during this pre-revenue R&D phase. Investors are fundamentally betting on transformative future cash generation once they flip the switch from R&D to operations.
Which brings us right back to the market momentum. We mentioned the rally closing recently, around $74.75, reflecting that huge 221% gain year to date. What are the technical signals saying about the stock? I mean, up at these kinds of levels.
Yeah, the technical picture still looks powerfully bullish, actually. The stock is trading firmly above both its 50-day and 200-day moving averages. That's a classic signal confirming a strong uptrend. And key momentum indicators, things like the RSI Relative Strength Index and the MCD, they're all still reading positive, suggesting the upward move has, well, maybe still has legs.
So the charts at least support maybe a continuation of this run.
It seems that way in the near term. The technical outlook seems to favor a bullish trading range, maybe somewhere between $68 and $85 over the next 3 months or so. But we also have to keep an eye on the short interest ratio. It's high, 26.54%. That indicates quite a bit of market skepticism, a lot of people betting against it. But it also provides the fuel for a potential short squeeze if some major positive news hits unexpectedly.
Okay, this really raises maybe the single most important question about this stock right now. With that massive run up, 221%, why the recent volatility? What are the big red flags signaling caution here? You just can't sustain that kind of rally without some serious pushback or challenges.
Absolutely. And that's where the skepticism really kicks in. We saw a pretty sharp sell-off, about 7%, right after that October 2025 announcement, the one about the $800 million at the market, or ATM equity program.
Right, the ATM.
Yeah, an ATM program basically lets the company sell new shares little by little directly into the open market. And that move immediately signaled dilution risk to investors, triggered selling pressure, even though the company said the purpose was to sort of fast-track deployment.
Dilution is always a huge concern, isn't it? Especially when the valuation is already so, well, rich. How did the professional analysts react to that ATM announcement?
Well, Scotiabank, for instance, they actually downgraded the stock, specifically cited valuation and execution risk. And they set a price target of $42.90, which is significantly below where it's trading now. And we also have to talk about the insider activity. It's pretty notable. We saw some serious profit-taking by key insiders, specifically the chief technology officer, the CTO, and the chief financial officer, the CFO. They sold large blocks of shares right after that rapid price run-up. The CTO, in particular, reduced their position by over 89%. That's a lot.
Wow, okay, over 89%. That is a massive data point, isn't it? When the execs who are closest to the tech and the finances are selling almost their entire positions at these price levels, that really undermines the internal confidence story, doesn't it?
It definitely injects a major note of caution, no question. But despite this insider selling and the dilution risk from the ATM, the overall analyst consensus is actually still a buy. However, and this is really critical, their average price target is somewhere between $45 and $45.82. That significantly trails the current market price, around $74. So the street seems bullish on the long-term story, but deeply skeptical about the speed and size of this recent rally. They basically see the current price is overbought.
Right. It sounds like the big institutions maybe are voting with their wallets for the long-term potential, even if the current valuation seems, well, kind of disconnected from the immediate financial reality.
That's exactly right, I think. Institutional inflows have risen rapidly, especially following those major partnership announcements. So smart money appears to be increasing exposure, essentially betting on the successful execution of the network build-out over the long haul.
Okay, let's look forward then. What are the immediate catalysts? The events over, say, the next 3 months that investors really need to watch, things that could either, validate this current price or maybe even push it towards that $85 bullish target you mentioned.
Yeah, the immediate focus has got to be on the next major earnings event. That's the Q3 2025 financial results due around November 13th. The market is going to scrutinize that report for any updated guidance on first commercial revenues, and probably most importantly, the specific satellite deployment timeline. That timeline really is the lifeblood of this whole investment thesis. Any slip there would be bad news.
And beyond the earnings sheet itself, what about operational milestones, things related to the actual tech working?
Well, the Bluebird satellites themselves, they absolutely must complete their orbital testing phase and move towards operational status. That transition from just being experimental hardware up there to being actual revenue-generating assets, that is the ultimate trigger. Operationally, that's the milestone that matters most, I'd say. We also keep hearing this persistent market chatter, rumors about a possible U.S. Tier 1 carrier launch partnership being formalized soon. And there's speculation that the money raised from that big $800 million ATM program could actually accelerate satellite deployment, maybe pull it forward from the original schedule.
Okay, those sound like potentially powerful tailwinds. But let's connect this back to the bigger picture risks. If we had to boil it down, what are maybe the three biggest headwinds? The key company-specific risks that could derail this whole, 9-10 bullish story we're hearing from some sources?
Yeah, it raises the important question of risk. And execution risk is paramount, number one. The successful, timely deployment of this satellite constellation, overcoming any remaining tech hurdles. That's the primary risk. If that timeline slips significantly, the valuation likely collapses. Second, obviously, is the ongoing financial risk. Continued high cash burn before they actually achieve sustained profitability. I mean, given the scale of the constellation they need, even $169 million in cash is ultimately a temporary buffer. They'll likely need more capital down the road. And finally, market risk. The whole satellite communication sector is incredibly capital intensive. And the company is always subject to this sort of cyclical investor appetite for these high-growth, currently unprofitable tech stories. Sentiment can change fast.
Okay, so wrapping this up, what does this all mean for you, the listener, the investor? The overall investment thesis, at least according to the sources we looked at, seems highly bullish. They rated it 910, driven mostly by that potentially disruptive technology and those big established global partnerships.
Yeah, the stock appears attractive potentially for both short-term trading, trying to leverage those Q4 2025 operational catalysts we discussed, and maybe for a long-term holding if you really believe in them capturing the market entry and building out this competitive infrastructure-level network. It's definitely a story about potential market dominance down the line. But the journey to get there, well, it's clearly filled with the kind of volatility we see right now, when analyst targets are around $45 and the stock's trading near $75. Big disconnect there.
So as you evaluate this opportunity, maybe we can leave you with one final provocative thought to consider. The trajectory of AST SpaceMobile seems to hinge entirely on its ability to convert those high-profile partnerships and its cash into scaled operational revenue, actually making money from the satellites. So as you think about that current valuation gap, maybe ask yourself this. Is the operational timeline, the actual deployment pace of the satellites, a more critical indicator of future success right now than the next quarterly earnings loss figure? Because that distinction, I think, determines whether today's valuation is justified tomorrow.
That's a great point to end on. Thank you for joining us for this analysis.
Yeah, thanks, everyone. We'll catch you next time on Investing Talk Podcast.